Questions about the Fed's next move are roiling markets for short-term investors. Treasury yields have been backing up. Even the dollar has gained a bit of strength because no one can gauge with any certainty exactly what the Fed will do. But how about the longer-term effects of QE2? We're going to explore that right now with Erik Upin. He is a former chief investment officer at Stanford University, which has the third largest college endowment in America. Erik is now CIO at Makena Capital, a private money manager overseeing some $13 billion for more than 40 endowments, including Stanford, and also for sovereign wealth funds. Erik is here with us at Bloomberg. Erik, look ahead for us. How do you think QE2 is going to play out?
Well, it's clear from Fred's statements we're going to see something. It's unclear and uncertain how to predict the magnitude. I think the big picture is there should be concern that we need it as opposed to comfort that we're getting it. And the question will be how much do we need and what will its ultimate impact be?
When you think about how the Fed is going to execute this program and how it is going to affect investors like yourself, does it matter that much whether it's $500 billion or $2 trillion? Is the long-term impact going to be the same? It's just going to be a differing degree.
Well, there are a couple different objectives. One, pushing down long rates can lower mortgage rates. It can cause refinancing. It can put more dollars in consumers' pockets. So it's an important tool and can have economic impact. It also can help be stimulative. The question is, how much do you need? We don't know the gravitational force of the deflationary forces at work, so we'll probably need to keep putting more medicine in the system until we start to get a response. Clearly, with all this response thus far, we haven't gotten the response that's been desired.
Well, and that is a big issue because there is some difference of opinion, shall we say, about what the impact of the next round is going to be. Is it going to spur growth? Is it going to spur inflation? Is it going to spur neither, or a combination of the two? At Makena, what are you anticipating, and how have you positioned your portfolio against it?
First is the recognition to be diversified and recognize that we're in very challenging times that are probably going to last for a great deal of time. Secondly, the outgrowth of this is both inflationary and also negative.
You believe that firmly, inflationary without a doubt.
Longer term, and that's the desired objective.
Sure. But the question is how inflationary?
And you may not realize and see that because to your question on quantitative easing, the more you do, the more there's a risk of policy mistake. And it's both a risk of inflation or currency decline.
Okay, so if they go higher, if they start with 5 and if they end with 2, again, we're talking about hundreds of billions of dollars and trillions of dollars, the closer you get to 2, the greater the risk of a policy mistake is what you're saying.
Yes. And that could be in the form of weakening currencies. It can be in the form of lower living standards as everything becomes more costly.
Let's talk about the relationship between weakening currencies and the U.S. vis-a-vis the rest of the world. You guys are big believers in emerging markets. Is there a big risk for emerging markets and for your investments there more precisely, the greater the Fed becomes committed to QE?
Well, we're very positive on emerging markets, and although a consensus view, we think the positive view is stronger than the actual portfolio weightings most institutions have at this point. So we still think there's additional opportunity there. But the real opportunity is that emerging markets are still export-oriented. So if there's a material slowing of the developed world, that could impact the emerging world, even though the long term is so strong there.
You just got back from China, from a trip to Shanghai. What is your sense of what the Chinese and other Asian economies intend to do? Do they intend to continue building up reserves? Do they intend to continue imposing capital controls? We just heard that from South Korea only yesterday.
From the one window that I look out, I think, one, the government officials are very aware of the issues. I'm always surprised at how cogent and on top of issues they are. Secondly, the long-term goal is building a consumption economy and raising living standards and creating more of a broader income distribution. So those things create a consumption economy that are less export dependent. That's the long-term goal. That's what we'll see evolve over time across the emerging markets in our view.
And that's part of your thesis?
Yes.
All right, Erik, it's always a delight to have you here in the Inside Track. Erik Upin of Makena Capital. He oversees some $13 billion for sovereign wealth funds, endowments, including his former employer, Stanford.